warm welcome to Financial Fitness Fridays. Darren Laverty here from Second Sight. For those of you that haven't been on one of these sessions before, this was born out of an idea by what's his Joe Wicks, of course, and he was doing that thing during lockdown, that keeping fit. So somebody said, why don't we do something on the financial side of things? So that's what we're doing. That's why I'm calling it Financial Fitness Fridays. So really today's about getting your sweat on. So this session it has a hard stop at half an hour. Okay, so I've got a very esteemed guest, a lady called Jenn Stewart, who is the director and head of the Money Advice Solutions team at Johnston Carmichael, because today is about debt management. And it's a tricky subject to talk about and navigate, and some people don't like to talk about it, but sometimes we just have to grasp that nettle and deal with it. So what's going to happen is after 30 minutes, we're going to end the session officially, but then what we can do afterwards is going to keep it open for questions. And I'm assuming there's going to be quite a few questions on this particular session, because it's an interesting subject. And then what I'll tell you a bit about what's going on next week. So also, if you've got questions, if you could put your questions into the Q&A at the bottom, don't use the chat box for that. Use the Q&A, because I've made it anonymous, because this is a sensitive subject. People aren't necessarily too keen to kind of expose themselves. So if you want to anonymously ask a question, if that question is relevant for the audience, what I'll do, I'll ask Jen, and Jen can then answer that question. So use the Q&A for questions, please. What I'll aim to do is then I'm going to look at them all at the end, okay? So when we get to that 30-minute stage, I'll get them at the end, and we'll pick out the good ones. And then if anybody's got any specific queries in there that need answering, we'll try to pick those up individually after the session. What's really important, though, for all of us here on this show is that you guys give us feedback, okay? Because what we want to do, we want to fine-tune these events going forward to make them the best possible experience and try to bring a bit of sunshine to gloomy times. I mean, I looked out the window this morning and we had frost for the first time this autumn. So we do need your feedback. We need you to tell us what you liked about it, what you didn't like, and you can score it, and any suggestions, that sort of thing. We really do welcome everything you've got to say, so that we can fine-tune these things going forward. So I'm just going to kind of do a bit of an introduction to this whole thing about debt, because I look at everything from a financial well-being perspective, and 80% of financial well-being is psychology and 20% is the mechanics. Now we're going to talk a bit about both today, and Jen's going to really help us with the fundamental, the mechanics side of things. But from a psychological perspective, the mindset is really important. It's our relationship with money, which is really important, our habits and our behaviors, because those are the things that are going to take us to our ultimate destination in life. So if somebody was in debt and somebody helped them get out of debt and then they repaid that person, if in that process their mindset hasn't changed, their habits and behaviors haven't changed, then it's highly likely they might go back into debt again. So we've got to work on both things. We've got to look at practical solutions, but also we've got to get the mindset right, the relationship to money, the control. And I always talk about financial well-being being made up of 4 pillars, and we're going to touch on one of those today. And those 4 pillars, if you look at the acronym, they spell the word WELL. So W is wealth, a wealth creation mindset, which is where we have future-focused objectives and a plan to achieve them. But that can even be from a negative standpoint. So we could be in debt, but our future-focused objective is actually to be out of debt and into savings. Okay. The second letter in that acronym, E, in WELL, is economic foundations. We need strong economic foundations, and that's what I'm going to come back to in a moment. We're going to touch on that. The L is low levels of financial stress, which we can have if we are in control of our money and feel in control. And that's not just from a mechanical perspective, the things we're doing, but also our understanding and our knowledge. And then the fourth letter of WELL is to live within our means, and this is a habit, a habitual thing. So the key thing is, I'm going to go back to strong economic foundations. That's made up of a number of points which I've mentioned in previous sessions, but one of those things is to have no high interest debt. Having high interest debt in our life is a bit like driving the car of life with a handbrake on. Okay, and also financial anxiety is the #1 trigger and cause of a lot of mental health problems in this country. And obviously with furloughing, with pay cuts, with redundancies, with the economy at the moment, there's a lot of pressure building on people. So I think this whole debt situation is getting worse. So But there are sort of three types of debt, and I like to look at them simply. There are there's three types: good debt, bad debt, and toxic debt. So let's just have a think about good debt for a minute. You know, not necessarily a bad thing. Why is it good? Well, it's good because it's debt that you've used to invest in yourself. It might be you've invested in your education. You know, you might have some student debt. If you invested in education to enable you to earn more money, you know, you could argue that's a good investment. Also, low interest debt that's asset backed, i.e. a mortgage. You know, if the interest you're paying is less than the rate at which the asset is growing, then you could call that an investment. So that type of debt is not a bad debt, that's a good debt, you know. The bad debt though, credit cards, overdrafts, store cards, they're charging interest rates of anything between maybe 10 to 40%. And what they love, these credit card companies, they love those people that make the minimum payments, okay? The minimum payments. And it seems to go on forever and ever. So I just want to ask you a question. In fact, what you could do, you could answer in the chat box, not in the Q&A, in the chat box. I'll ask you a question. If you imagine you had a credit card and you were making the minimum payments each month, okay, how long would it take you to clear the debt down on that credit card, on the average credit card interest, okay, if you make the minimum payments, how long would it take? What would be the term it would take for you to pay off that credit card debt? Anybody want to chuck some answers into the chat box? Just out of interest. 5 years, no. 5 to 10 years, no. 3 years, no. Someone said 50 years. You're the closest, I think. Endless. Okay. As you can see, just knowing this is really powerful. The actual answer is 26 years and 9 months. Okay, 26 years and 9 months of a credit card making the minimum payments. So a bit crazy to just make the minimum payments. But what happens when you make the minimum payments? You do that for 12 months on the trot. Okay, you made your payments. Suddenly the credit card companies, oh, you're a good payer. Why don't we give you some more credit? So they extend your credit limit. And they write to you, by the way, you've got another couple of £1,000. Here's your extended credit limit. For a lot of people, they come back and look at that and that becomes a new target, you know, so we need to get out of that kind of situation. The other thing that goes on in the modern world is social media marketing. You know, what they do, they target us. They use our psychology against us. They know what we're Googling. They know what we're looking at content-wise on social media platforms. And they suddenly put you into an audience knowing that you're interested in a subject. They bombard you with adverts. And they bombard you enough to a point where actually you get that impulse and that urge to buy it. And then what happens is we've got things like Amazon with buy it now. So they get the urge, the psychology to have something now, and then they make it easy, the mechanics, to buy it now, get it tomorrow. So that's kind of the modern day world we're kind of having to deal with. So the third debt is toxic debt. This is like your payday loans. Now, I remember going back many years ago. I mean, I've been doing this job for 31 years and going right back when credit cards first came into society. There used to be an advert called The Flexible Friend, and it was a little character, a credit card with little arms and legs, and he used to have a little pound sign running around with him. It was like cash was the poor relation to credit, and it normalised credit cards. Terrible. And then in more recent years, go back the last 8-9 years, Wonga, you know, payday lenders, you know, they created little old people puppets to normalise debt, normalise that kind of payday lending, but they charge extortionate interest rates. Now, with all the fees and everything else wrapped up, you come up with what's called an annualized percentage rate. The maximum they can charge is now 1,700%. 1,700% is the APR, the maximum they can charge, and a lot of them do charge it. In fact, a lot of them charge 4 times that a few years ago before the regulations came in. So even with the regulation, it's 1,700%. So just to put this into perspective before we introduce Jen, let's imagine you borrowed £100. Okay, and you can use the chat box for answers again if you like. If you borrowed £100 and you applied 1,700% interest to it for 4 years, okay, £100 at 1,700%. Now this is unrealistic because you'd pay it off sooner, but just play the game with me. £100 debt, 1,700%, 1,700% for 4 years. Have a guess how much your debt would have accrued to at that interest rate over 4 years. Any answers coming in there? Any guesses in the chat box? 100k, someone said. Forever. 100k. No. I can tell you what, after this event, get your calculator out and try it. It's over £8 million. Okay, so we want to avoid going there, and anyone you know going there. So without further ado, I'm going to introduce you to our lovely esteemed guest, Jenn Stewart. Jen, are you there? Yay!
Good morning.
Welcome to the Financial Fitness Fridays.
Thank you very much for having me today. Delighted to be here.
Excellent. Really looking forward to listening to what you've got to say on this really important subject, a subject which has really got more and more important this year, hasn't it? For sure, you know.
Yep.
I do have a whole bunch of questions for you, and I'm sure there's going to be loads of questions from the audience as well. So should I just get cracking with my set questions?
Absolutely. Fire away.
Brilliant. Thanks very much. So just to start off with then, and what advice would you give to someone that is just starting to notice that they're using an overdraft and starting to creep into their credit cards a little bit more than usual, which I think could be a lot of us this year?
Yep. Well, I think the first thing I would say is recognition. I think that your expenditure is exceeding your income and that you're becoming more reliant on credit with the use of overdrafts and credit cards is a really positive step, because if you're burying your head in the sand, not addressing anything, that recognition point is really, really key. The next step is that actually individuals can need to take control of their financial situation, understand exactly what is going on. And in order to do that, you need to really have a full awareness of what debts you actually have, what that household budget looks like, again, so you know best how to manage household bills and debts that you may be dealing with. So there are a couple of steps that you can take to gain control of your finances. And like I mentioned there, understanding what those debts are and how much is still to pay is absolutely critical. Collect all the information about your debts, look at the contracts, look at the bills, look at the statements, make a list of these debts, write them down. And the details might include, you know, who you owe money to. This is often referred to as your creditor. How high is that interest you're repaying? And Darren's just touched on that. When you've missed a first payment, how much you owe, your account and reference numbers, what activity has the creditor perhaps taken to get that money back. And I would really emphasize the point, try not to worry when you see all your debts written down, because the important thing here is that a start has been made to actually sort things out. You also need to have that full understanding of the financial situation in the household. How's it best to manage those household bills and debts that you may actually be dealing with? Making a budget is really crucial. It's a crucial step towards taking control of your finances and getting your situation back on track, because budgeting helps you to see where money is going. It's easier to make sure that you've covered all the things that you need to actually pay. You know, making that budget is a great way to identify the areas where you make savings. So, for example, energy bills. You might also find that you're actually spending more on than you thought on interest charges for credit cards, overdrafts, catalogues. And as most of your household bills and debt payments are made monthly, I would also suggest that you try and basically make all your figures monthly, change everything into monthly amounts. And don't forget those bills that basically are only paid for once a year. For example, Christmas, car repairs, vet bills. And to simply get that into that monthly format, just work out your yearly cost and divide it by 12. It gives you that monthly figure to include in your budget. And if you're not sure what you're spending your money on, try writing everything down for a month, and it'll give you a clearer idea of your regular spending. You know, some of us do weekly or monthly shops, but others go to the local shop 2 or 3 times a week, and you know, there's just money that seems to just drip away. So taking that time to work out a budget to cover your living costs and debt payments can help you take control of your finances and your life again, which really plays into that well-being part. It can also put you in a much better position to deal with those unexpected expenses that sometimes fall in. So whether you're worried about missing important payments or simply wanting a clearer picture of your finances, there are lots of benefits to making a budget. And if you're looking to seek help at an early stage, the first question anybody is going to ask you are, who do you owe money to, and have you prepared a budget? So if you're having problems making your monthly payments, I really would recommend contacting, you know, an advisor who can help resolve this.
I'm just thinking that for a lot of people, I would imagine, I've been doing this job for a long time, and there are people out there that are avoiding the pain of just accepting the situation. They're kind of avoiding it, kind of blocking it out, not going there. And it's very difficult sometimes. What you're talking about is logical. Let's take some action, take control. And it's easier said than done, I think, from a psychological standpoint. One technique that can be used there is actually play the movie of your life into the future for, say, 2 or 3 years on your current plan, on your current strategy, and just look at the world then. And suddenly what happens is, if that is a very black picture, the pain of that black picture can be enough to get you to start the process now, because actually that's a bigger problem than the one you've got to currently overcome. So that's a really powerful thing, to play the movie forward into the future. The other thing I do like is budget planners. It sounds a bit tedious and boring, but actually the Money Advice Service do a great one, free of charge. They're not trying to sell you anything. You can stick your information on there, but what I love about it is you get the facts right in front of you. There's no hiding places. It's right there, your situation. And if you don't like it, you have a little shock. And sometimes we need that. Sometimes we need that little trigger to change our behavior, to change our habits. So I would highly recommend focus on where you might be 3 years on the current plan. That might not be great. Come back to today. Now the first step to get control is a smaller problem than the big one coming down the road. Do the budget plan until you get to the facts and you can see your own situation, and that you might not like, but that is your trigger to change. So, okay, brilliant. What about someone that's maxed out on, say, 3 credit cards, paying the minimum payment each month? What could they do?
So again, if someone is maxed out on 3 credit cards, it does sound like their debt situation is slightly spiraling out of control. And if they're not careful, credit cards can be a really expensive way to borrow, especially when it takes such a long time to pay off what you own if you can't pay the balance. So again, as we've already touched on, just making that minimum payment is the lowest amount that you can pay in your credit card balance. When you only make the minimum payment each month, the debt takes such a long time to reduce, because your payment mainly goes towards the interest, and only a very small portion of that goes towards paying back the actual balance. And credit cards are covered by the Consumer Credit Act, and it means there are strict rules that your creditors must follow if you are struggling to pay your credit card bills. And I'd refer to the points that I made in the first question about the importance of really understanding your finances, and so they know exactly what you can afford each month. Work out the budget by listing income and expenditure without relying on any further credit, and turning this into a monthly plan. Use this budget to set aside an amount to repay your credit cards, and it can help to transfer this amount into a separate bank account, because if you set aside an amount to actually pay and it's ring-fenced in another account, you can't touch it to use on anything else. I would also say stop using your credit cards, even if it's just for a short time. You do need to question the need as to why do you have 3 credit cards. And get some free debt help if you're not sure what to do. There are money advisors able to help you with your budget, advise you about different solutions, and set up a repayment plan or solutions that are right for your own individual circumstances.
So I just think, in terms of that, there's another idea that I learned recently, and I think it's a good idea from a psychological standpoint rather than necessarily from the financial standpoint. It might not be the cheapest way to get those credit cards cleared off, but it might be a strategy that will actually achieve the desired outcome. And that is that basically we've got 3 credit cards. Here's the idea. One of them is going to have the lowest balance. So on the 2 that are highest, pay the minimum on those, but then pay as much as possible off the small one, because that will get paid off and cut up quickest. So let's say that 6 months down the line, that one's gone. Psychologically, we're down to 2 cards from 3. And I think that really helps boost our endeavour, gives us that confidence and that motivation. It's a bit like once we've been dieting for 3 months, we're more likely to keep it going. After 3 days, we don't. And then once we've got the 2 cards, go then to the one that there's the lowest balance of those 2 cards, pay down as much as possible on that one, pay the minimum on the larger one, get to 1 card quickly. So it's probably not wise from a financial standpoint, because we haven't looked at the interest rates on the different cards, but certainly from a psychological standpoint, it's not a bad plan for a lot of people. So what about people to the next level of financial anxiety? What about someone that's got maxed out on credit cards, they've got rent arrears, they've got council tax arrears, utility bills arrears, and an overall high level of financial stress? What would you say to those people?
Well, if this scenario resonates with anyone, then it's really time for them to seek some help and again try and regain control of their finances. I think it's important to highlight here that as well, they're not alone. Many individuals' debts have become unmanageable, and it can be due to a number of factors out with their control, whether that be loss of income, health reasons, surprise bills, relationship breakdowns, just by way of an example. So, if someone is having debt problems, they will find it difficult to make payments to their creditors. And actually, they might find that creditors contact them to actually put pressure on them where they can't actually afford to pay anything. So, again, taking a step back, there are some straightforward steps that can help you take control of the financial situation. And again, it's about understanding what debts that they have and what the makeup of that debt is. So actually pull together all the information about the debts, such as again, contracts, bills, statements, make that list of debts and write down the details of each debt. Again, it's who are they due the money to? Whose name is the debt in? Because if someone else is joint and severally liable for the debt, that's also a key point because it may then not just be one individual, it could be two individuals that are joint for the debt, albeit one may have spent the money. Have any of the payments been missed? How much is owed? And again, has the creditor taken any action to try and recover any of that debt? Have they perhaps been sending letters? Has a sheriff officer or a bailiff been to the door? Is there any court action pending? So again, if you're not sure of who to pay because things have basically gotten so out of control, then I would suggest obtaining a copy of your credit report, because this way that'll show you the money that's been borrowed, what the outstanding balances are due to the lenders. And it's a good idea to get these copies of the credit reports. And you can get free copies of your reports from agencies such as Experian, Equifax and TransUnion. Ask for the statutory reports, and it really is worth getting these.
Ask for
because
the what? Sorry,
the statutory reports.
Okay.
Yep.
What's that?
It's basically the report that will just give you the factual detail of exactly who the lender is and what the outstanding balance is.
And so the companies you recommended there were Experian, Equifax, and who's the other one?
TransUnion.
TransUnion. So people just Google them, they can go on, put the details in and get a credit report, can they?
Yep, sign up for the free report, and often you get the option to get a free trial, and that's what you want to do. And then because you're not then having to pay any monthly subscriptions for that.
Brilliant. Okay. So you mentioned third-party intervention. I think sometimes we all need all the help we can get out there. And we mustn't be too proud. I mean, this is one of those taboo subjects for a lot of people. They don't, they don't want to talk about it. So mental health and financial problems are two big taboos, especially in the workplace. You mentioned third-party intervention. You get the free sector, and then you've got the non-for-profit organisations. Can you explain a bit more about the pros and cons of some of those organisations and name a few that could help?
Yep, absolutely. So again, mentioned the free sector, and there are several agencies and charities that can provide free debt advice, and such as Citizens Advice, Step Change, who's the UK's largest debt charity. There's the National Debt Helpline, and a lot of your local authorities have money advice departments as part of their trading standards teams. There's Money Advice Scotland, and there are lots of smaller debt charities. So there are so many advantages and pros really about dealing with the free sector. I think the key point is it is free. There are trained and qualified money advisors in most of these agencies that are used to dealing with all of these problems on a day-to-day basis. So you may go in thinking, gosh, this is a problem that I have. Nobody else is in this situation. But actually, it is their bread and butter day-to-day work. That is what they're doing. These agencies will help you work out your budget, your income and debts, and basically just help you get control of your situation again. They will use the information provided by you to find a solution to your debt that suits your situation. And they'll assist you in setting up some of the debt solutions and offer support, however long that might be needed for.
And any areas that they may be lacking in?
Yes, I think there's the issue of waiting times, and sadly, due to the COVID pandemic, that's obviously just really been exacerbated. That access to some of this free money advice in these charities and agencies is more difficult. There's also a lack of funding in a lot of these agencies. So again, there are reduced staffing. And again, a lot of the people you may speak to could be volunteers, so they are not actually qualified individuals. They're not qualified licensed insolvency practitioners, and therefore not able to implement all of the solutions. So they would have to refer you on to another third party.
Yeah. So could we just to end that question then? So could you just remind people of the names of some of those not-for-profit organisations that they could go to? So I think the Money Advice Service we spoke about.
That's right. Citizens Advice.
Yeah.
Step Change.
Yeah.
The National Debt Helpline.
Brilliant.
And any of your local authorities will have money advice departments in there as well.
Thanks very much. So we've done a bit of credit card bashing. I have had a little note come through. It's a good point, actually. Someone said, look, use of credit cards, not necessarily just for credit purposes, but perhaps for safety in purchasing. So yes, used sensibly and repaid at the end of the month. Absolutely. So let's not forget that. So thanks for pointing that out to that person that did. Okay, final question for you on this section of it before we wrap up is, what about private sector professional support? What are the pros and cons of that? I've heard of this terminology, an insolvency practitioner. What are they? Where can you find one? That sort of thing.
Yep. So the private sector also offer debt advice, and in some instances it is also free. If someone's financially distressed, the importance of getting good advice is impossible to overstate. The Financial Conduct Authority regulate financial advice in the UK, and this includes all debt advice given by free debt management companies and by charities. So any firms who are authorised and regulated by the Financial Conduct Authority have to hold the relative permissions to provide debt advice to do so. So it's really key that you're always looking that wherever you're seeking advice, that they're regulated by the Financial Conduct Authority. Now, a licensed insolvency practitioner is someone who is licensed and authorised to act in association with an individual, a partnership or a company facing insolvency. And most insolvency practitioners are accountants or insolvency specialists working in firms of accountants and are experienced and qualified advisors and able to provide debt advice. Insolvency practitioners also have additional layers of regulation and are regulated by official bodies such as the Institute of Chartered Accountants in England and Wales, the Institute of Chartered Accountants in Scotland, for example.
What does it exactly do? What exactly does it, in simple terms, what does an insolvency practitioner actually do as a solution?
Yep. So the role of an insolvency practitioner is to, to assist an individual or company basically take control of their finances. Their job is to essentially look at realising any assets and any contributions that are made available from the individual or the company to repay the creditors in a fair and reasonable manner. So they essentially sit as the middle person to actually make sure the individual is treated fairly and make sure that the creditors are repaid the money back as to what's due to them.
And how do they earn their money? Because I imagine if I'm in such debt, how do I compensate an insolvency practitioner?
Yeah. So essentially the insolvency practitioner is paid through throughout the statutory process of the insolvency. So it's actually the creditors who are picking up the cost of the solution at the end of the day. So there is no. Yeah.
Okay, well, look, thanks ever so much. So we've come to the end of our 30 minutes, the official formal end, but we're going to keep going in a minute. I do need to, for regulatory purposes, share, I'll tell you a bit about next week, and then also I need to bring up the caveats. So that's next week. So next week's session is mortgages and the property market. So again, we'll have another specialist guest coming in. We've done this once before, but we've got lots of feedback about other bits that people want. So we're going to talk about mortgages, remortgages, property, buy-to-let, those sorts of things. The caveat is there. The thing that we need to point out, the Sponsor De Novo, who's the parent company of Second Sight, does not provide advice or arrange debt management plan. Right, so that's that stuff done. I'm going to stop sharing now. For those of you that are happy to get onto your next meetings, that's fine. Those who want to hang around, give me your questions now, and then we'll pose those to Jen and see what we can come up with. So let's have a little look what we've got so far. Again, your questions are anonymous, by the way. I've anonymized it, so in the Q&A section you can ask a question quite happily. No one's going to know who you are. Okay, so Hannah, oh, sorry, didn't they say your surname? Question here: are there any good free apps for helping to monitor spending?
I think there are multiple apps that you could potentially look at. I would always say that you're much better to actually speak to an individual, and actually monitoring your spending is essentially just going back to the basics of either writing it down, putting it in a spreadsheet, and essentially this is what my income is, this is what my expenditure is, and this is what I've got left at the end of each month.
Yeah, I think there are some banks, I believe, that can actually do some analysis of your spending from your bank statements. Are you aware of those, Jen?
It's not something that I've seen on a day-to-day basis. You know, I think there are multiple apps out there that you potentially could use that may assist. But I'm sorry, I probably couldn't recommend one off the top of my head.
Well, somebody just popped an answer in here, actually, thank you very much for that. I've been using the Emma app, and it's pretty life-changing for me, seeing everything in the same place. So there's a good recommendation. So again, this is about taking control, because where does stress come from? Financial stress. Stress comes from feeling out of control. And, you know, we're never going to be permanently in control forever, but we need to kind of operate on a daily basis within a tolerable level of stress. And you know, there's two things we can do to actually remove or reduce that stress, and that's to physically take control, to take some action to do that. The other thing is to learn and understand in more detail, so we've got more knowledge, and those two things combined can help us. But we can't stop learning, we can't get complacent, because the world keeps changing, as we've now been shown this year. The world can change and life can change very quickly, so we just need to stay in touch with it. And as long as we feel in control of most things financial in our life, then we should manage that level of stress. If we Sorry,
I was going to say, I think the key point is, regardless of whether you use an app or whether you're writing it down, but having the visibility and control of your circumstances and actually seeing what's there is absolutely key, because it just means that you've just regained that control and recognition of what your circumstances are.
Yeah, I've got a question here from someone. I'm not sure if you can answer it, Jen, because it's probably more to do with someone that's a lender, but it says, question repurchasing a car, like for like on a particular car, ownership or PCP contracts, which makes better financial sense.
Again, that all comes down to your individual circumstances, and actually looking at the kind of finer detail of, do you want to own the car at the end of the period, or do you simply want to just actually lease it? What's the best deal and rate that you're actually getting on the at the time? So it comes down to really your individual circumstances.
There's another good question here, and I've got part of an answer for it, because it's part of another session that I run. But the question is, I've been told it's better to keep a student loan because the interest is low, but surely it's better to repay it in one go if possible. What do you suggest?
Yeah, and again, it comes down to your individual circumstances, because you're looking at, do you have the ability to repay it? I suppose the pessimistic insolvency practitioner in me says, if you've got the wherewithal to repay it, then you should just do so. But actually, if you're in a relatively secure job, you're able to make the ongoing payments at the smaller amounts, then there is potentially no harm in doing that. I always look at what happens in 5 years' time if your circumstances change and you couldn't have paid it off when you actually had that lump sum earlier to be able to do so. It would then have discharged that.
Yeah, there's a couple of interesting facts I was researching this week, actually, and that is that the student loan company charged 6.1% on student loans. And the average student debt currently is 35,000. They were saying on this. This is right up to date. This came out this month.
Yep.
35,000. For a lot of poorer families, those youngsters are going to have up to £50,000 because there's less family support along the way. But what I found was interesting was that the interest on the student loan, as it builds up over the term of the university course, the interest alone has increased the debt by £5,800 even before graduation. So the other thing is, at 6.1%, let's imagine you've got £35,000 of debt, and let's imagine you've got £35,000 in the bank. So the question is, should I pay the debt off? Well, unless you're getting more than 6.1%, on your savings, which you're probably not, it might be wise to pay it off. I know sometimes we get a kind of like a security blanket with the cash accessible and all that, but probably a combination of things. And again, it all still down to individual circumstances and individual attitudes and opinions and stuff like that.
Yep.
So, any more questions? Have a little look what we got coming through. Anything here? I've got some questions which are a bit too personal, so we'll pick those up afterwards. Okay, well, I think we might be done. So that's it, right? Okay, I think we've run out of questions. So thanks very much, everybody, for jumping on. Thanks very much to Jen from Johnston Carmichael for really helping us out and sharing with us your wisdom. Really appreciate it. You know, as you know, these Financial Fitness Fridays are not promoting or marketing any particular product or service out there. Absolutely not. That's not what it's about. And Jen has given her time free of charge today to share with us everything we need to know about debt. Thank you so much for jumping on board. And hopefully I also look forward to seeing a load of you next week for the mortgage session. So thanks very much. You take care and good luck, and have a lovely weekend, and good luck on your journey to financial well-being. Take care. Thanks, Jen.
Thank
Bye,
you.
everybody.
Bye.